All right, it was a rough rough trading session for technology. Semiconductors got hit, crypto got hit, gold got hit. I know it's not necessarily technology, but it's been pretty positively correlated with crypto. So all the risk assets got hit today, and our defensive sectors actually led the higher. Healthcare, staples, utilities leading the way to the upside today. So we're going to talk about this rotation. Is this the rotation, right, or is it just a buy the dip opportunity? So I'm going to break down in tonight's market outlook preview. What are some of the signs that suggest that it might be a little bit more than what we've seen lately with the buy the dip signals. So let's go ahead and get started. Today is Tuesday, November the 4th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, click this link right up here in the top right corner of your screen. That takes you to our Market Outlook blog post. Everybody gets this for free on our website. It's a detailed description of what happened today, why it matters, what to watch for next, what we're looking for. Again, if you click that link, it will take you to a page that looks like this. And you're like, where is everything? Well, if you're already a member of Market Scholars, just click on the login here button. If you're not, and you want to see this free post here, with the preview video, which is posted at the top, then click this free button, join free and unlock this post. Click that blue button. It takes you to this page. This link right here also takes you to this page, and you can see how fast it is. Just come down here to the bottom, fill out this form, hit sign up, and that gets you logged into our subscription to our site. You can get this every day, and you can see when you go to the archives up here, Market Outlook video archives, you can see you get access to all of the free Market Outlook videos. And on Fridays, you get access to the full version of the, not just the preview video, but as you can see here, the free Friday video is available for all of our basic subscribers as well. All right, now let's talk about what's happening in the markets today. So you can see it was a pretty broad sell-off here. The markets were down, but really the big sector that was down, and what we've really been paying close attention to, is the chip sector, right? It was down 3.6%. That obviously had an impact on the NASDAQ 100 as it was down 2% today. In fact, not the biggest loss for the NASDAQ 100, but one of the bigger drops that we've seen. We had one on October 10th, of course, over 2%, and then of course August the 1st is over 2%. But that's it. Like since we started to bounce off that, especially off that April 21st low, we haven't had any others. This is the only other 2% decline, and of course you had a pretty decent sized gap here that we just built on by the time the day was over with. You also see too that had an impact on the breadth. The breadth was really poor, so it wasn't just like a narrow, just the NASDAQ 100 stocks dropping and everything else rallied. There's a pretty good chunk of the markets dropping here. In fact, the summation index is almost below zero. Also as a result, the VIX rallied here up to 19, so not quite above 20, and still in bullish territory here. And one bright spot on the day is that the VVIX did not close above 110, so the VVIX stayed right around just barely above 100. So that's a good sign actually, and suggesting maybe we might be close to the peak in the VIX as the VIX itself approaches its 200-day moving average here. If I take a look at some ratios, obviously the Qs had a really rough day relative to IWM, but if you take a look at some other sectors, like one of the worst performing sectors was discretionary, and you can see how it's been struggling relative to healthcare. Now, the ratio is typically very positively correlated. It has not been lately. That usually precedes more of a decline, and we saw that earlier this year when we had our pullback into correction mode at the end of February. There was a negative correlation with this ratio as discretionary stocks started to underperform here before the market started to drop. But we're seeing that again with discretionary stocks underperforming, the S&P still holding up, and then you can see that the ratio is pretty strongly. So again, if this continues down and the ratio and this turns up, and that's what happened earlier this year. We go into pullback mode and we break the 200-day moving average. So that's a really important ratio to be paying attention to. I also mentioned I mentioned the breadth was really poor, and that The net new highs and lows are down at low levels, well below minus 100 now. The average itself is starting to drop. That's a pretty decently low level there. The number of stocks above the 50-day moving average also breaking down to below 200 for the first time. The trend jumped up to a high level. The trend measures the difference between the two ratios, right? The advanced decline ratio, and then the advancing declining volume ratio. So much bigger number on the volume in terms of decliners versus advancers than the actual on volume versus just the actual issues themselves. So as a result, the trend jumped up to a very high level, and that can happen towards the beginnings of these pullbacks, as we saw back here on February the 25th. Just a few days into that pullback, we had a similar move in the trend up to a very strong level. So we're seeing that again. And of course, the other issue that's impacting risk appetite, at least negatively, is the dollar, as the dollar continues to slowly rise higher. And that's putting pressure on risk appetite, and also putting pressure, for that matter, on gold, as gold was down, continued to be down, dropping below the 30-day moving average, and Bitcoin is dropping below the 200-day moving average today. So pretty significant breakdowns and these kind of anti-dollar trades, and those two asset classes happen to have been pretty strongly correlated with the S&P 500. So they're breaking, and that makes you wonder if the risk appetite in general will start breaking along with them. All right, so that does it for our Market Outlook preview video. If you click this link up here, that will take you to our Market Outlook Foundation page. That will subscribe you to our site for just $29 a month. You will get access to all of our full versions of the Market Outlook. So not just these little 5-minute previews, but the full 30-minute version. I go into a lot deeper detail, and I give you my expectations of what I think is going to happen and why. You also get access to the trade ideas. We do one trade every day at the end of every Market Outlook video. We actually do it before the market closes at 3:30 Eastern time on our website on the live stream called the Market Outlook Live. You get access to that every day. You also get access to our the Market Outlook Trade Tracker, where we track the results of all those trades. So not only do you get these 30-minute videos about what's happening and why it matters, and what I think will happen and why, but also all these trades that we take throughout the course of the year. And like I said, we track the results of those trades. And they've been doing pretty well for most of this year, this calendar year so far, year to date. So again, just $29 a month works out to be a little less than $1.40 per video. Thank you very much for watching. Subscribe to our YouTube channel down there. Click that subscribe button, click the thumbs up icon to like tonight's video. Share the video with anybody else that you think would be interested. Comment down there below on what stood out to you. I'll tell you what questions you have. Let's keep this conversation going. Follow me at DavidSettle42 on Twitter for more content between the videos. You can also follow me on LinkedIn and on Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.